One way we describe the process is if you think about, a great investor, right? How do they, build up their intuition and their decision-making capability around buying investments? Well, they've been investing for years and years and years. They sit on boards, they watch their successful investments and they watch their bad investments, and they see the outcomes and they learn from those outcomes. What we're doing is basically saying, what if you could give a model, an investor, all the experience that could have been had over the last 50 years? They had the opportunity to invest in every company and see every outcome and learn from that.
Welcome to Excess Returns, where we focus on what works over the long term in the markets. Join us as we talk about the strategies and tactics that can help you become a better long-term investor.
Justin Carbonell and Jack Forehand are principals at Validia Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validia Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validia Capital.
Hey guys, this is Justin. In this episode of Excess Returns, Jack and I sit down with John Alberg, co-founder of Euclidean Technologies. We talk to John about the firm's use of machine learning in stock selection. We start with the basics of machine learning and then dig down to how Euclidean uses machine learning to forecast fundamentals and select value stocks. We get into where machine learning may go in the future with investing and whether or not machine learning could someday outdo even the best investors. The use of artificial intelligence and machine learning is a rapidly developing area of investing. And this discussion with John provides great insight on how one firm uses machine learning to help predict outcomes in equities. As always, thank you for listening. Please enjoy this discussion with Euclidean Technologies' John Alberg. Hi, John. Thank you for joining us today.
Thanks for having me.
We're going to spend most of the time talking about machine learning, your investment process, valuing stocks, and where things may be headed in the markets with the increased use of machine learning and artificial intelligence. But to start, I wanted to ask about your pre-value investing career and success. So based on what I know about your background, you had co-founded what was basically a high growth SaaS company in the web 1.0, maybe transition to 1.2 time period that eventually was bought and taken over by ADP. So that was a very nice, successful exit for you. But what I sort of personally find interesting about this story is, it's a unique path for someone that basically eventually became a value investor, which we're going to talk about your value approach, but you kind of went from this high growth, not startup, but high growth, successful business with a successful exit to basically this value investing sort of orientation, I guess. So maybe can you just talk a little bit about that experience and what ultimately led you down the path to value investing, and also like what you're focused on just generally at Euclidean Technologies?
Yeah, that sounds great. It's right. I have had kind of two careers. So the trajectory sort of started all the way back when I was at Williams College in Massachusetts. And one day I was in the math library doing homework and got bored and went through the stacks and found this book on, there was collection of papers on neural networks, which is a big form of machine learning. And one of the papers described the backpropagation algorithm, which is the core algorithm by which most, machine learning happens. And I was just dumbfounded by this idea that instead of programming computers to do things, we could actually borrow from the analogy of how, people learn. We could teach them how to do things by example. And so, I kind of went all in on machine learning at this kind of young age, wrote a thesis on neural networks, graduated from Williams and went to work for Booz Allen and Hamilton, which is the management consulting firm. They have an office in DC, which, where they do a lot of government work. And we were doing, it's probably like back in 1995, this was probably the only job you could get in machine learning. I mean, machine learning was just not on anybody's radar. So, for me, it was super exciting. It was this crack group of, guys from MIT and Caltech. And we were working on these kind of really innovative problems, like looking at satellite images, to try to detect objects in a scene, doing credit scoring. That was a commercial application, and doing fingerprint recognition. But, it was the mid 90s. And so there's two things. One, mid 90s, it was clear the internet was going to be a big thing, right? And two, I started to realize that back then there just wasn't enough computing power to really create sophisticated ML models. These things like neural networks require vast amounts of computing power to work effectively. So I kind of said, look, I'm a computer science guy. I think the real opportunity right now is in the internet. And so I co-founded with a good friend of mine, a Williams college classmate, this company called Employees, which was basically SaaS for human resource and benefits management, which, software as a service, in the mid 90s was a pretty crazy idea. I mean, we were before Salesforce.com. It was very early at the time. Enterprises were sort of dominated by Oracle and PeopleSoft and Microsoft with the client server model. This idea of putting, software in the cloud in a data center and having, many people access it was very novel. So it was super exciting. We spent the next 10, 12 years building that company. And then in 2006, we sold it to the biggest payroll company in the world, Automatic Data Processing. But throughout that whole time, my heart was always with machine learning, right? That was where I, got started. And I just, was in love with the idea of being able to teach computers to do things by example. And so I just made some money off the sale of my company. I knew I had to invest this money so I could grow it over the remainder of my life. And I thought, well, what skill set do I have, which, I could apply to this. And I also knew that at the time, no one in finance was really using machine learning. There were no real commercial applications of machine learning back then, like there is today. And so I thought it was, kind of a neat opportunity, this idea of, gathering a bunch of data and seeing if you couldn't use machine learning to, pick stocks for a portfolio.
And the value, I guess, orientation, maybe that comes out after, that's the output of the machine learning process or algorithm. So is that how you landed on value, or was there some other influence of value that had you think about using value in the machine learning sort of technique?
Well, let me first talk a little bit about machine learning and what exactly it is. And then I'll explain how that, got me to value. So what is machine learning? There's actually a bunch of different forms of machine learning: supervised learning, unsupervised learning. But all the machine learning you hear about in the news, the stuff that Google does and Amazon that makes these huge breakthroughs in language translation and image recognition, self-driving cars, that's all what's called supervised learning. And so just to focus on supervised learning for a sec, is in supervised learning, what you're trying to do is learn a mapping from input to output. So the input might be, weather data, what's the cloud cover today? Is it raining? What's the wind speed? What's the barometric pressure? And the output might be, is it going to rain tomorrow or not? Right. It could be, that's a simple problem. A much more complicated problem would be the input is, a sentence in French and the output is a sentence in English. In the case of investing, the input might be all the information you know about a stock at a point in time, and the output might be how well did that stock perform over the subsequent year. At any rate, the goal of machine learning is to learn to map input to output. And that process is done not by, me programming it and saying, this is how you get from A to B. It's by presenting an algorithm with lots of examples of, French sentences and the English equivalent, millions of examples of that. And then the algorithm basically tweaks the model, typically in an iterative way, but not always, tweaks the model such that it minimizes how much error it makes when it, basically the difference between what the model outputs and what the target example is, what the actual, English sentence is. And that process is called, the process of error minimization. And again, it's typically an iterative process. And the idea is that by minimizing that error, the model eventually learns to map A to B. So getting back to, like, how did that take us to, being effectively a value investor? It's that the way I pose the problem and the way that Euclideans always thought about the problem is of investing and machine learning is, how do I build a better stock picker, right? It's not like when a lot of people like apply math and data to investing, they're trying to do things like statistical arbitrage or portfolio optimization. At the end of the day, I just wanted to build a better stock picker, right? So it makes sense, right? Like if you think of other areas of machine learning, like self-driving cars, what are you trying to do? You're trying to build a better driver. Another, big area of machine learning is looking at medical images and trying to predict whether there's a cancerous, tumor in the image. What are you doing there? You're trying to make a better radiologist. So what I was just trying to do is say, let's, to the extent that investors can just look at publicly available information and decide whether something's a good investment or a bad investment. What I was essentially just trying to do is, replicate that, but not through experience, but substituting that experience with basically all the data that has, ever, going back to the 1950s on companies, all the information about companies and their outcome. So how do you set that problem up? What you do is you take at each point in time, every company and all the data that is available about them. It could be, that data could be in the form of factors like, price to book, or it could be, or return on capital, or volatility of earnings over the last 5 years. Or with more advanced machine learning, you can just feed it the raw data, like raw financial information, going back 5 years or 10 years. At any rate, as I described earlier, the whole process of machine learning is you're trying to minimize this error function, right? In the output, the difference between what the model's outputting and what the actual outcome was. And so one way to set that up for investing is you give it fundamental data for each company at each point in time. And then you say, as the output, did it outperform the market over the subsequent year or not? And then you feed that to the machine learning algorithms, and it tries to minimize the error of predicting, whether, this company at this point in time would have outperformed the market or not over the subsequent year. And the point there, though, is like when you do that, it definitely, that model, if you set it up that way, so your error function is, does the company outperform? And the input is fundamental data and, maybe the price of the company, it will absolutely converge to have a value bias. It's like if you could ask the data, let's say you had a conversation with the data and you said, okay, how could I use you to pick companies that do well? It would tell you, well, you want to do something like this, and it has a value bias. And momentum too. I mean, and so this goes by, this shouldn't be a surprise. How many thousands of papers have tested various value factors and found efficacy, going back a long, long time. And true of momentum too. And I'll say momentum will, if you give it momentum data as input, it will pick up on that and it will use it, and it will improve your model. But that's just what the data says. And it should be no surprise then that if you look at most systematic investors, be it AQR or Alpha Architect or so, they have a value bias, and they don't have a value bias because they're, dyed in the wool value people. It's just what the data told them works over the long run.
Before we get into your strategy a little bit more, because it's really interesting, I wanted to ask you first about just the idea of how much data is available, for a machine learning process in investing. Because I was reading this research paper from Research Affiliates a long time ago, and I wanted to read you a quote from that and sort of get your reaction to it. The quote was, "Today we have 55 years of high quality equity data, or less than 700 monthly observations for many of the metrics in each of the stocks we may wish to consider. This tiny sample is far too small for most machine learning applications and impossibly small for advanced approaches such as deep learning." I'm wondering, what do you think about that?
Well, I read that, and it's hard for me to make sense of that, because when I think about, you know, what I'm trying to do, which is pick stocks, right? So he's multiplying what 500 by, or 700 by the 700 observations. But what I'm trying to do is pick stocks. So there are 5,000 stocks, available at any point in time, at least. Maybe not going back all the way to the 1960s or whatever, but there's probably on average about 3,000 to 5,000 stocks. Well, and then you have each point in time, there's a potential forecast. So for me, when I think about that, there's, 5,000, times, the 700, which is like more than 3 million. So they say that, so that makes it, in my mind, if I'm thinking about what the input examples are and what are the output, the input being companies at each point in time, and the output being, did it outperform the market or not? To me, there's millions of examples of that. If on the other hand, let's say we were trying to predict not whether a company will do well or not, but let's say we were trying to predict whether the S&P over the next month is going to go up or down. Then you're right. You really only do have, 12 times 55, whatever, about 75 observations, because you're building a model to try to forecast the S&P. But like what we're doing is trying to generalize from looking at lots of companies to build a model that we can apply to new companies. So what they say is typically for, there's sort of old school machine learning, which is simple models. And then there's the new stuff, which is deep learning. They say with, traditional machine learning, you need 10,000 plus examples to, build a model. And then with deep learning, the newer machine learning that has, made huge strides in the field, you want at least 100. I mean, I've heard different things thrown around, but you can start with 100,000 or so examples. So, I think, given that there are millions of examples of companies at different points of time with different outcomes, there's plenty of data. There's not as much data as there is, say, to build a language model, where you have all of Wikipedia and every book that's ever been read. But there is still certainly enough data.
And to your point too, if you think about this as sort of a process that learns, I mean, human beings also have a process that learns. So if human beings have 55 years of data and 700 monthly observations, then you would think if it's sufficient for people, it would be sufficient for this as well. One of the interesting things you guys did is, a lot of the machine learning models I've seen used in investing, they attempt to predict stock prices, and you went a different direction and you attempting to predict fundamentals. I'm wondering if you could talk about why you did that and sort of how that works.
Yeah. So it gets back to this fact that there's kind of two. So there's like the traditional machine learning, and there's this newer deep learning. And so let me just explain that difference real quick. When back in the traditional learning, kind of the best models out there are these things called decision trees, or ensembles of decision trees. Kind of everybody knows sort of loosely what a decision tree is. You follow down a path, and you use your inputs like that weather data to say, oh, is barometric pressure above this, or is it raining today? And you end up at a leaf, and it says, oh, it's going to rain tomorrow, or it's not. That's what a decision tree is. And then this notion of ensemble of decision trees, they've shown what works much better than just a single decision tree. And it's kind of loosely related to the idea of wisdom of crowds. You build, a bunch of different models. So that's kind of the more traditional approach to machine learning. And actually for most problems, that is an amazing solution. It works really well at a typical problem. But, go back to like 2005 and like language translation, image recognition, voice recognition, and a bunch of other stuff like that. It was just terrible. There was not, AI was terrible, right? It was way worse than what a human could do at all those tasks. But then somewhere in the 2010s, all of a sudden, like, when you're in Gmail, it's completing sentences for you. Language translation is as good in many cases and better than what a professional translator could do. All of that was because of the sort of advent of deep learning. And what is deep learning? So deep learning is based on this idea of an artificial neural network, where the models are very complex. There's many layers to these artificial neural networks. And so the model is able, through all those layers, to untangle very complex relationships in the data. So when deep learning came along and was making all these incredible, when it came along and there was all these amazing innovations and it was breaking all these records in terms of performance on things like image recognition and language translation, of course, at Euclidean, we want to look at all the new stuff that's coming out with machine learning, because we're basically a company that is formed around the idea of applying machine learning to investing. And Google and Amazon and all these other, Facebook, were pouring, billions of dollars into ML research and really pushing the envelope. And so we sort of felt that, we had made a commitment to our investors to always evaluate whether we can improve our models through innovations in machine learning. And so we explored the use of deep learning, so this sort of kind of newer technique, to the problem that, of investing. And what we found, which was pretty interesting, because at the time we were using these ensemble of decision trees models to basically do what I explained earlier, which is, try to predict whether a company is going to outperform the market over a 1-year period of time. What we found is that using deep learning, it didn't perform any better than this more traditional machine learning techniques on that problem. And what we speculated was that the problem is just very noisy, and there's a lot of extraneous factors that are involved with whether a stock's going to go up or down that are way outside what fundamentals can say about what it's going to do. And when problems are that noisy, and you have a very complicated model like a deep learning model, it tends to fit the noise. And that's exactly what you don't want. You want your model to fit the signal. And so that when you apply the model, to new data, it's not kind of looking for the noise, it's looking for the signal. So that's essentially what we found, is that deep learning applied to trying to predict how well a company is going to do from a stock price perspective, was no better than what we could achieve with ensembles of decision trees. And so, but there was also this thing going on. You probably are familiar with this when you're typing, if you use Google Mail, you're typing an email and it completes your sentence, right? Or tries to complete your sentence.
Yeah, I've seen that.
Well, that's a deep learning model. And it's this idea of sequence to sequence learning, where you have a sequence of data and you're trying to complete that sequence. And so if you think back to what, how machine learning works, is how do you do that? Well, your input is the beginning of the sequence, random, all sorts of sequences, and your output is the end of the sequence. And you're trying to learn to map, the input sequence to the output sequence. So it occurred to us that, this is uh, um, financials, historical financials on a company, such as, what's on the earnings, income statement, what's on the balance sheet, and what's on the cash flow, the cash flow statements. That is a sequence of financials that goes back, however long the company's been around. And so you could think of, you could posit this problem of, what if you could use a sequence to sequence learning model to sort of use it to forecast what the next step is going to be in the sequence of financials. So, we basically know, the financials of a company from, March of 2022 going backwards. And so let's, build a model that attempts to forecast what the next step in the sequence was. Now, this problem is less noisy, right, than, trying to predict the stock price of a company. And so the thinking was, well, maybe if it's less noisy, maybe it could improve upon what we were able to achieve when we were trying to, forecast what how the company will perform from a stock price perspective. And so, we set out to do that. There's a lot to it, but eventually that culminated in a paper that we first published at, one of the most prestigious machine learning conferences, NeuroIPS, and then subsequently we got a subsequent paper that focused on uncertainty in those forecasts at ICML, which is also a big machine learning conference.
Do you have certain core variables you're trying to predict, or are you pretty much trying to predict everything on the income statement, the balance sheet, the cash flow statement?
So we are. So that's a good question. We did this study. Like, first of all, when we came up with the idea of sequence to sequence learning on financial statements, we thought, well, is it even valuable to forecast financials, right? Like, what you really care about at the end of the day is what the stock price is going to do, right? So is it even valuable? So we came up with this idea, we call it the clairvoyance study. And we said, what if you could predict what the fundamentals of a company will be perfectly 1 year out? And then we have these sophisticated stock portfolio simulators. And so, obviously you can't do this for real, because you don't know the future, but we just said, assume you do. How well would you do performance wise? And we did it for a bunch of different factors. So we did it for future cash flow. We did it for future, operating income. We did it for future sales. We did it for future book value. And what we found was that if you could forecast, or if you knew perfectly what the future operating income or the future cash flow would be, you just do amazingly well, right? Now, again, I got to caveat that it's not possible because you don't actually know the future. But what it implied was that if you can forecast the future with any degree of success, that you could probably very much improve, a value-based strategy, by trying to close the gap between what you could do if you knew the future perfectly and what you would do if, for example, you were just using trailing 12 months operating income.
So are you, beyond that, are you applying standard valuation ratios? Just the idea is you're applying them against a better predictor of fundamentals than what other people have available. Is that kind of the idea?
There's a couple parts to that, but the first part is yes. So what we do now is we have this deep learning model that forecasts operating income into the future. But it's much easier to do that, right, than it is to, forecast what the price movement is going to be. And so that's important. And then we use that operating income, we divide it by, the current total enterprise value, which is, a pretty typical way to do, that's a good factor. It's when people test different value factors, kind of the ones that percolate to the top are EBITDA, EBIT, one of those two over enterprise value. And so what we do is we forecast those perform the best. If you compare them to, book to market or price to earnings or sales to, market, the EBIT and EBITDA over enterprise value really performs well. So we forecast that EBIT, divide that by enterprise value, we rank stocks, and then, we buy, whatever the ones that rank high on that. But that's not all of it, right? Because forecasting is still, well, it's easier to forecast, future EBIT than it is to forecast future price. There's still a lot of error in that. And we know that with consensus estimates, right? People are always, making estimates on what future earnings are going to be. But, we know that that's not always right. And you can look back, the error rate is like, 25 to 30%. And doing that with ML, with a deep neural network is maybe a little bit better, but not dramatically better. But what you can do with ML, which is incredibly powerful, is this notion of quantifying the uncertainty in that forecast. If you think about like when you're watching, the Weather Channel and they're showing a picture of a hurricane, a hurricane going into Florida, they don't just show a line, they show a whole cone of uncertainty around that line. And what they've done there is they've quantified, all the different paths it might take, knowing that there's a lot of uncertainty in these forecasts. And so we kind of, took this idea. Amazon had been doing a lot of research in forecasting and uncertainty. And, we piggybacked on some of that research. And we started to build models, which not only forecast, what future EBIT's going to be, but how much confidence or how much certainty do we have in that forecast? We were basically building uncertainty cones around that. And if you think about that, what it allows you to do is sort of quantify the idea of margin of safety, right? So like the idea of margin of safety is, I think maybe this company can probably make, $100 million next year, but there's some uncertainty in that. And so what I'll do is I'll, use a lower number, which I think I can be more confident on, and see if the company is still cheap on that lower number. So if you think about how we use that in at Euclidean, is we forecast these uncertainty cones, and so you can basically discount forecast EBIT over enterprise value by that uncertainty, and it at least in simulation. Portfolio simulation, it improves the performance quite a bit.
That's really interesting. So the idea is basically if I have two companies that have the same EV to EBITDA, but one company has a much tighter range around the EBITDA, then I'd probably want to invest in that company rather than the one with the wider range. Is that sort of the idea?
Yeah, if they're the same price.
I want to ask you, I just want to shift to value traps quick. I was reading, I think it was your most recent quarterly letter,
Yeah.
but it was one of your quarterly letters. And, I've always thought this is one of the better uses of machine learning, is this idea of trying to limit value traps. We know as a value investors, there always are going to be some of them, but the idea of limiting them, because this is probably one of our biggest problems, is really interesting to me. And you talked in your letter about using neural networks to try to minimize value traps. And I'm wondering if you could talk a little bit about how you did that, and sort of how much success you had in maybe reducing the number of value traps.
Yeah, so we've done it now with deep neural networks. We originally did it with just the decision trees, and it's always been an important part of our process. And yeah, right. There's a lot of companies out there that may look cheap. They look cheap on current EBIT to enterprise value or whatever your valuation metric is, but it's going to, but for some reason, it's going to turn out that a year from now, that EBIT is going to be way smaller, and your model doesn't know that. And so it looks cheap, but it's not. And so what we did is, going back to that problem of like, does a company outperform the market or not, as the output and fundamental data as the input? What we did is we posed the problem this way. We said, give the model as input all fundamental data, again, so it's sort of like for the original model, but you're only going to look at companies that are cheap. So you're sort of carving out the inexpensive universe. And that inexpensive universe could be on forecast operating income to enterprise value, or it could be on trailing 12 months. But the basic idea is you carve out the top 30% of cheapest companies, and then you assign, a 1 or 0 to each company, which is, was it in the bottom decile of performance over the next 12 months or not? And so basically 10% of the data is assigned a 1 in the bottom decile, and 90% of the data is not in the bottom decile in terms of performance. But again, it's within the space of value. And then you basically train your model to try to forecast whether it's going to be a value trap or not. And, it turns out that we just from fundamental data alone and momentum, of course, momentum's a strong factor. It can, it gives us the ability to remove some value traps.
And you may not be able to give this away because this might be part of your secrets, but are there certain fundamental variables that were like very important in terms of limiting value traps?
With deep learning, what the model's doing is a little more opaque, but we did this with decision trees at first, and you can analyze those very, very easily. And yeah, I'm perfectly comfortable explaining what some of the important factors were, but they were really around consistency of operations in the business, like the volatility of earnings, over the last several years. There was a leverage ratio in there. So like if the company's too levered, but then momentum too, right? So if the recent stock price momentum is really bad and it's already a cheap company, then that was a pretty big factor as well. Retained earnings to assets was a big factor in that. But yeah.
Yeah, that's really interesting. And it's interesting, and this sort of gets to my next question, is a lot of those things would be things that would make sense. You would say as an investor, without using machine learning, like those things should have an impact on limiting value traps. And this sort of gets to my next question, which is, all of us that are factor investors have this idea that our factors should be intuitive. So in other words, they should make sense. And I want to read you a quote from Robert Mercer, and he's doing, Robert Mercer Renaissance, and they're doing a very different type of investing than you and I are. But, what they've found with a lot of their models is that idea really doesn't matter. So his quote basically is, the signals that we've been trading without interruption for 15 years make no sense. Otherwise, someone else would have found them. And I'm wondering, how important is it that the factors that the machine learning model finds are intuitive, that they make sense to us? Or is it possible for it to find a factor that maybe doesn't make sense to a human being, but have that factor continue to work in the future, even though it doesn't necessarily make sense?
Well, so here's the thing, like the way that I've set up the problem, with fundamentals and momentum and as the input and how companies can perform, or their earnings is what we're trying to forecast. I just have never had it come back with something wacky, right? It's always, if a company's been kind of growing, then it's probably going to forecast it continuing to grow unless there's a whole bunch of debt. Or if the operations are really inconsistent. If it did come back with something wacky, I don't know what that would be like, but number of employees, I don't know. So, I would probably investigate, I'd probably be like, okay, is this picking up on, did I set something up wrong? But I think, at Rentec, they're pretty quiet about what they do there. So, they may be, their problem is set up differently, right? They're maybe not looking at fundamentals as much. Maybe they're focused more on kind of market dynamics and that sort of stuff. So,
yeah. So it sounds like you're probably tackling this problem by only feeding it data that, should have something to do with stock prices. So, there's always that joke about like the S&P 500 being correlated with butter production in Bangladesh. I mean, you're not feeding the butter production in Bangladesh into your model. And so you could have more confidence probably that what it's coming out with is going to make some sense.
No, I mean, that's a good point. I mean, yeah. And that kind of gets back to something you were saying earlier on how, yeah, like, with machine learning, um, these factors make sense to us, right? Return on capital and volatility and, uh, you know, price, the price ratios and so forth. But the one thing that machine learning and deep learning does allow you to do is it allows you to bypass that whole process of factor engineering, right? Instead of, saying, okay, I think that, EBIT to enterprise value, or I think that sales to enterprise value, or I think that volatility of return on capital is good. When we give the data as input to our deep neural networks, it's basically seeing the financial statements as they were presented. There's no ratios. And we talked about deep learning, how there's many layers and it can find complex relationships. So what it is doing is it's, kind of coming up with its own factors. It's letting the data guide the process of finding what's the best way to evaluate this information. Right? I think really that's what machine learning brings to the table, is it allows you to not, to approach it in sort of an unbiased way, or it can find novel things that, people wouldn't think of. Again, I've never had it, come back, except maybe in cases where something was not set up right, come back with something that just doesn't make sense.
So we have established that the output of the model, mostly brings you into these types of value stocks. I'm just curious, do you tend to find them being more Ben Graham deep value, or are they more like value and quality, which would be Greenblatt, or is there quality sort of factors in there generally when you look at these positions?
So I would say the answer to that is somewhere in the middle, between Buffett and Graham style models, where certainly the companies that it picks are very inexpensive. But if you were to train a model only on, what it needs to do evaluation and leave out all the stuff it needs to assess, the leverage of the company, or how stable its earnings are and so forth, it would the model would perform a lot worse. So my point is, adding all that extra fundamental data, it gets used. And so it's using that to say something about, whether this is a good company, whether this is a company where you should have confidence in, that their earnings are going to be, X in a year from now. I'll also add that if you do that and you don't include momentum, it does worse as well. So, that momentum does play an important role. And I think that the reason that is that if you look at our forecasts, the time that they perform the worst is when there's known information out there that's not included in the historical fundamentals, right? So take this example of a company who, I think they were a cell tower company, or a cell tower equipment manufacturer, but they had 3 customers, and one of them was AT&T. And they, the CEO was like, we're losing AT&T. Well, the fundamentals look great, growing. And so the model is going to say, okay, it's growing, but we know that, 30% of its revenue is about to go away and its profits are going to drop like crazy. And so it's those sort of scenarios where a model based only on historical fundamentals is going to get it wrong. But that short-term momentum piece, like when the CEO makes that announcement, the stock drops. So the model can be like, oh, I need to revise my forecast because I'm getting some kind of signal from the market that they know something that I don't.
Yeah, it's a good example of how momentum, I think, can help identify those problems that, aren't going to necessarily be picked up in the financials, at least immediately. And that it sort of leads somewhat into the next question, which is, over the last, I'd say maybe 5 years or so, obviously the importance of intangible assets has become much, I think, more understood. I mean, maybe those investors, and there has been investors talking about that for a long time, but, I think particularly like systematic value investors, that use the price to book have now realized that, as more and more value becomes intangible assets that aren't necessarily reported on the balance sheet, that becomes an issue when using traditional, sort of financial statements and some of these ratios. So how do you think about sort of that challenge, I guess, when running your models?
Yeah. So, the original quantitative investors or quantitative investor thinkers, Fama and French, they chose book to market as their their valuation ratio. And so there's so much literature and so much data that's based on that. Kenneth French has that great website with all the factor models on it going back to, the 1930s, which, is a great trove of data. But the unfortunate thing is that it's all based on this book to market, value ratio. And in fact, most of the industry forever, I think I've noticed there are a lot of funds that have changed this over the years, but it's kind of, when people say value, they, that style box is largely based on book to market. But as we know, book value, does not include, the extent that the true value of the intangibles. And if you look at, book to market as a factor over the last, 5, 10, 15 years, its deterioration is much worse than, the other value factors, which, have, all value in the last 5 years has had, challenging time. But book to market more so. And I think the reason is probably obvious, right? That, that as we've moved more towards a service economy, a technology-based economy, more of the assets that a company has are not quantified in that book value number. And so it's, not, a fair way or a good way to value the company.
When the machine learning models look at that, will they kind of figure that out on their own? So will they look at things like, R&D and SG&A and basically say, these are very important factors? Is that kind of the way they'll think about intangibles?
Right. So going back to, this idea that you can just feed the raw fundamentals to the model and it kind of is able to figure out what's important. You give it the opportunity to do that. And allow it to leverage that information. I'm not sure. I don't think the model at all pays attention to book value. It's really focused mostly on, what can this company earn?
Have you noticed, I mean, you've been obviously running this model for a long time and developing these models. And so as these models learn, is it a noticeable change in the composition of the portfolio? I mean, obviously the fundamentals are always changing in the market, and there's always a jockeying between companies or industries or businesses that are growing and that where there's value based on some of these value metrics. But, if you were to take a snapshot of 12/31/2020, 12/31/2010, and then, I don't know, 12/31/99, would you see a lot of difference in the types of companies that this model would be selecting? Because since it's constantly learning, you would think that, it wouldn't necessarily be like heavy in financials during all those periods or whatever type of, area it's finding. Does that question make sense?
Yeah, it does. And so it does change through time. I mean, and, what's that driven by? It can depend. Sometimes it's just driven by valuation, right? So I remember looking at the 80s and the packaged food industry, for whatever reason, was, being captured as, ranked high by our models. These days, sometimes it's more focused on energy. So yeah, it does change over time. And I think that can be, for more than one reason. It could be just because that industry is getting beat up from a valuation perspective, or it could be that, there's, fundamentally, these are better companies now. It just kind of depends on the situation, but there is a cycle there. There's an interesting question there. Is like, when you build these machine learning models, should you weight the present, like the last 10 years more than, 20 years ago or 30 years ago or 40 years ago? And we've tried that, right? We've tried to look at, putting more emphasis on, more recent periods. And surprisingly, it didn't improve performance of the model.
Just wanted to ask you a few more questions here before we wrap up. Do you think there are still areas of investing where a human investor is better than a machine? And, before we jumped on with you, Jack and I were talking about like, we were like, okay, so let's name like a really great successful value investor. And obviously who comes to mind? Buffett. But then we were like, well, wait a minute. Who are the really successful value investors that are out there in the market today? And obviously there's far less and less of there's many great discretionary investors, but in terms of these guru investors or superstar investors, maybe there's a few guys at Fidelity that have great long-term records. But I mean, do you think there's areas where humans are better than machines?
I mean, I do think that, so the only way to do just amazingly well in long only investing is to have a very concentrated portfolio, right? 10 to 12 stocks. And I do think we're not there yet with machine learning, that if you want to build that kind of, stock picker, you need a tremendous amount of confidence around every name that you invest in. And, the models are just not producing estimates that can give you that kind of confidence. So I would say, that I think that there's big opportunity though, still unfound, which is basically in the area of natural language processing. So much of the information that exists about a company at any given time, so much of the information that like a Buffett or a great investor who has a concentrated portfolio, I know he doesn't anymore, but at one time he had a very concentrated portfolio. So much of that information they're getting by reading or listening to transcripts. Going back to the example of the wireless, systems company that was going to lose AT&T and 30% of their revenue, you can't get that from the financials, the historical financials. But you can get that if you read the transcripts. Well, where has machine learning and deep learning really advanced? It's in this area of natural language processing and also computer vision. And I mean, Google and others are releasing these incredibly sophisticated language models these days. And so being able to have a machine that can read those texts and say, hey, look, the CEO just said we're losing the biggest customer. We need to adjust these. We need to adjust our forecasts accordingly. In theory, it could do that. And so like today at Euclidean, that's where 100% of our effort, I mean, I feel like we've taken fundamental data and that's quantifiable and structured. And we have basically, done everything you can to figure out how to use that data to select stocks. So the remaining, the remaining area is, use unstructured data and really take advantage of what deep learning can do to help make a better investor. And maybe we'll someday, be able to make one that could have much more concentrated portfolio.
Yeah, that's great. I was going to ask you, where you think 10 years from now, where you think what machine learning could be doing for the investor. But I think you answered probably part of that with what you're working on right now, and maybe the use of other alternative data sets too, and coupling that with the fundamental research that you're doing.
Yeah, no, I think that's right. I think unstructured data, good unstructured data, and it's challenging because we have this structured data going back to, whatever, the 1960s with really high quality structured fundamental data and stock price movement and so forth. But this textual data, is much more spotty as you go back in time. So one of the really important sort of technical problems we're working on is once you have a model that's just fundamental based and has been built using data going back 55 years or so, how do you augment that model with the new unstructured data to, attempt to improve performance, even though that data doesn't go back all the way to, 1965 or so.
And our standard closing question that we like to ask all of our guests is, if you could, based on your experience in the market, if you could impart one piece of wisdom or teach one lesson to your average investor, what would that be?
I mean, I think, there is a very easy way to do okay in the stock market, right? And that is buy an index, and odds are, you will do very well over your lifetime. Picking stocks is very hard. It's incredibly competitive. And so if you're interested in it, you just got to think about, how much do you love it? Right. And you also have to think about your temperament, because with any strategy, there's going to be times like 2008 where it goes down, 37% or so. And, just, for some people, it's just, I think, better to lock it away and not have to think about it every day. But for others, if you're passionate, and you feel like, you don't worry too much about the daily ups and downs, then, it can be a really exhilarating thing.
Great, John. Thank you very much. If people want to learn more about what you're doing, read your research, which I highly recommend, any piece you guys put out, I try to get my hands on it pretty quickly, or follow you on Twitter, where can they go to learn more?
Euclidean.com. We try to be very transparent about what we're doing, and we publish, lots of research articles up there, and also our more formal research papers as well. So anybody who's interested, I'd encourage them to take a look.
Great. Thank you very much, John. Appreciate it.
Thank you.
Hi guys, this is Justin again. Thanks so much for tuning into this episode of Excess Returns. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at JJCarbonell. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.